Imagine getting a mortgage quote on the morning after the Federal Reserve announces no change. The policy rate is unchanged. The press release says, maintain. The headlines say, pause. Then your lender refreshes the screen and the number beside your 30-year loan is higher. Same job, same credit score, same house, same down payment. The central bank stood still. Your mortgage did not. That is not a hypothetical description of some distant crisis. In 2026, the Fed held its overnight target at 3.50 to 3.75% through 5 consecutive meetings. Yet Freddie Mac's average 30-year mortgage fell to 5.98% in late February, then climbed to 6.66% by the 30th of July. It reached a one-year high without a single change in the Fed's target. For a buyer borrowing $400,000, the July move alone from 6.43 to 6.66% adds roughly $61 to the monthly principal and interest payment. Compare late February with late July, and the increase is about $177 a month, or nearly $64,000 if that difference lasted for all 360 payments. Taxes, insurance, fees, and the price of the house have not even entered the calculation. The natural question is incomplete. Why is the Fed allowing mortgage rates to rise? It assumes the Fed posts a national mortgage price, like a utility setting the price of water. It does not. The Fed controls a very short-term interest rate. A fixed mortgage is a long-term bond with a homeowner attached, and an entire market decides what that bond is worth. The Fed matters enormously, but influence is not control. Its policy rate anchors the price of overnight money and shapes expectations about tomorrow. A mortgage rate must also compensate for three broader forces: the future path of rates and inflation, the special risks hidden inside mortgages, and the lender's cost of delivering the loan to a particular borrower. Three layers are hiding inside the number on a mortgage. Quote, the first is the Treasury baseline, the market's long-term price of money. The second is the mortgage. Market premium investors demand for owning mortgage-backed securities. The third is the lender's retail layer for turning that market price into one borrower's loan. A Fed pause controls only part of the first layer. Even the familiar rule that mortgages follow the 10-year Treasury is only the beginning. In late July, the 10-year yield rose to 4.75%, but that still did not fully explain a 6.66% mortgage. The missing distance contains one of the strangest bargains in finance. When rates move in the homeowner's favor, the investor can lose, and when rates move against the homeowner, the investor can be trapped. To see why, follow one mortgage after the papers are signed. A bank or mortgage company gives the buyer money and receives a promise of monthly payments. The loan may have a 30-year contract, but the originator often does not plan to wait 30 years. It can sell the loan, recover its capital, and use that money to make another mortgage. Many qualifying loans are gathered into mortgage-backed securities, known as MBS. Fannie Mae and Freddie Mac purchase eligible mortgages and issue or guarantee securities backed by them. Ginnie Mae instead guarantees securities built from federally insured or guaranteed loans, including FHA and VA mortgages. Investors receive payments from large pools of homeowners. Credit protection reduces default risk, but the cash flows can still change at exactly the wrong moment. This secondary market is why a buyer in Arizona and a pension fund in Europe can be connected without ever knowing it. The buyer sees a monthly bill, the investor sees a stream of principal and interest. The lender stands between them, creating the loan, hedging it while rates move, arranging the paperwork, selling or servicing it, and charging enough to cover that machinery. Treasury securities provide the starting point because the United States can borrow in dollars with minimal default risk. If an investor can earn a certain yield from a treasury, a mortgage-backed security must usually offer more to justify its extra complexity. For a 30-year fixed mortgage, the 10-year treasury is a useful public reference, although the match is not exact and changes as borrowers behave differently. A 30-year mortgage rarely remains untouched for 30 years. People sell homes, refinance, move, divorce, inherit money, or pay principal early. That makes the expected life of the cash flow shorter than the legal maturity. In calm conditions, it can resemble an intermediate-term bond. When rates change, however, its expected life changes too, which is why no fixed formula can permanently link mortgages to one treasury maturity. A long-term treasury yield is roughly a forecast plus an uncertainty fee. The forecast is the market's expectation of average short-term rates over many future years. The fee, known as the term premium, compensates investors for locking money away while inflation, growth, policy, and demand for bonds remain uncertain. Neither part waits for today's overnight rate to change. This is the first reason a pause can be misleading. A Fed announcement describes the price of money. Now, a 10-year bond prices a path. If investors expected several cuts and new data make those cuts less likely, the 10-year yield can rise even while the current rate stays fixed. The market has not ignored the Fed, it has changed its estimate of what the Fed may have to do later. Inflation is central because bond payments are fixed in dollars. An investor lending $1,000 for 10 years cares about what those dollars will buy when they return. Higher expected inflation reduces that future purchasing power, so investors demand a higher yield. A single monthly inflation report may reverse, but persistent uncertainty can keep long yields elevated even when the policy committee chooses to wait for more evidence. The current episode contains exactly that uncertainty. By June 2026, the Fed's preferred PCE price index was 3.7% above a year earlier, while core PCE was 3.3%. Energy shocks linked to conflict in the Middle East, earlier tariff increases, and strong demand in parts of the high-tech economy complicated the path back to the Fed's 2% goal. A pause under those conditions is not a victory lap. Long yields can also rise because the term premium changes. Investors may demand more compensation when interest rates become volatile, when the economic outlook splits between inflation and recession, or when long bonds look harder to sell without a price concession. This premium cannot be observed as neatly as the Fed's target. Economists estimate it, markets argue about it, and homeowners feel it in a quote, government. Borrowing adds another layer. The Treasury must sell enough bills, notes, and bonds to finance maturing debt and new deficits. If the supply of long-term securities grows faster than the appetite of buyers at existing prices, yields may need to rise. That does not mean every auction or every basis point is a referendum on the deficit. It means supply and demand still apply to the safest benchmark in the system. In July 2026, the 10-year Treasury moved from about 4.48% at the start of the month to 4.75% on the 31st of July. The Fed's target did not move. Investors were weighing higher expected policy rates, resilient demand, inflation, and energy risk, and the compensation required to hold long debt. Mortgage rates broadly moved in the same direction, reaching 6.66% in the 30th of July weekly survey. The July Fed decision made the distinction unusually clear. The committee voted 9-3 to hold the target range steady, but all three dissenters wanted a quarter-point increase. A headline reading, "Only Fed pauses," sounded neutral. A bond investor reading the vote saw a meaningful chance that policy could remain restrictive for longer, or even become tighter if inflation failed to improve. This is why the word pause contains almost no forecast by itself. A pause because inflation is falling rapidly is different from a pause because policymakers are divided about another increase. A pause before a recession is different from a pause during strong investment and stable employment. The number may be unchanged, but the information surrounding it can move every longer-term interest rate on the screen. Treasuries explain the floor, not the full mortgage. On the 30th of July, Freddie Mac's weekly mortgage average was 6.66%, while the daily 10-year Treasury yield was 4.68%. The rough gap was close to 2 percentage points. That comparison mixes a weekly borrower average with a daily government yield, so it is only an illustration. It is not the technical MBS option adjusted spread. The largest mortgage-specific complication is the homeowner's right to prepay. In most American fixed-rate mortgages, the borrower can refinance or repay early without compensating the investor for all the interest that disappears. This right is valuable to the homeowner. Like any valuable option embedded in a financial contract, it has a cost, and that cost is built into the return investor's demand. Suppose an investor buys a pool of mortgages paying 6.5%. If market rates fall to 4.5%, many homeowners will refinance. The investor receives principal back early just when replacing that income requires buying new bonds at lower yields. The borrower exercises the right to leave precisely when the old loan has become most valuable to the investor. No, reverse the move. If market rates rise to 8%, homeowners with 6.5% mortgages are unlikely to refinance. They may also avoid moving because selling would mean surrendering a valuable loan. The investor's principal returns more slowly, just when it would be useful to reinvest at the new higher yields. The security becomes longer-lived when the investor would prefer it to become shorter. This asymmetry is called negative convexity, but the name is less important than the bargain. When rates fall, investors lose their best loans early. When rates rise, they keep their below-market loans longer. Investors respond by demanding extra yield, and they demand more when rate volatility makes either outcome harder to predict. That premium passes through the MBS market and eventually reaches the borrower. Imagine a restaurant promising that customers may cancel an expensive reservation after food prices fall, but may keep the old price indefinitely after food prices rise. The restaurant would charge more at the beginning to survive that promise. Mortgage investors do something similar. The analogy is imperfect, but it captures why the ability to refinance is not free, even when no separate line item appears on the closing statement. MBS spreads also respond to ordinary supply and demand. Banks, pension funds, insurance companies, real estate investment trusts, foreign institutions, and the Federal Reserve can all buy mortgage securities, but they have different funding costs and risk limits. If a major class of buyer steps back, or if banks prefer treasuries, the remaining investors may require a wider spread before absorbing the same amount of mortgages. The Fed can influence this market through its balance sheet, a channel separate from the overnight policy rate. During quantitative easing, it has purchased large amounts of Treasury securities and agency MBS. Those purchases remove some duration and prepayment risk from private portfolios, bid up bond prices, and can narrow the spreads passed to homeowners. A rate decision and a balance sheet decision are related, but they are not the same lever. That distinction matters in 2026. The Fed ended its broad balance sheet runoff in late 2025 and began buying Treasury bills to maintain ample bank reserves. Yet its agency debt and MBS holdings still declined by about $91 billion from early January to the 1st of July because principal payments were redirected into Treasury bills rather than replacement MBS. The balance sheet grew while the mortgage portion shrank. The reverse shows how powerful direct MBS demand can be after the Fed announced additional agency MBS purchases in September 2012. New York Fed research found that MBS yields fell roughly 30 basis points over 2 days and option adjusted. Spreads narrowed about 25 basis points. The overnight rate had not performed that work by itself. The buyer entering the mortgage market had changed the market's price. After the bond market prices in MBS, the retail lender still has to turn that price into a quote. The difference between the mortgage rate paid by a borrower and the yield on a newly issued agency MBS is called the primary-secondary spread. It covers guarantee fees, servicing, hedging, personnel, technology, compliance, capital operational risk, and profit. It can widen or narrow independently of treasuries. Timing makes this layer especially important. A lender may promise a rate today, but close and sell the loan weeks later. During that interval, Treasury and MBS prices can move. Lenders hedge the pipeline, and hedging costs rise when markets become volatile. If applications arrive faster than a company can process them, it may also raise quoted rates rather than hire permanent staff for what could be a temporary wave. This helps explain why two qualified borrowers can receive different quotes on the same afternoon and why one lender may improve before another. Companies have different funding, capacity, servicing strategies, investor relationships, and appetite for a certain type of loan. A national weekly average is useful for describing the market. It is not a price tag that every lender is required to honor. The borrower changes the price too. Credit score, loan size, down payment, property type, occupancy, debt, to income ratio, and whether the loan is a purchase or cash out refinance can affect the rate or upfront charges. The safest way to compare offers is to hold those facts constant and request quotes close together, because a market move can otherwise make 2 different days look like 2 different lenders. Points create another source of confusion. A borrower can often pay more upfront for a lower stated rate or accept a higher rate in exchange for lower closing costs. The annual percentage rate spreads certain finance charges across the loan's scheduled term to aid comparison, but its practical value depends on how long the loan is actually kept. A low rate bought with expensive points may pay off only after the break. Even date put the chain together, and the quote becomes less mysterious. Begin with the Treasury baseline, add the mortgage market premium for prepayment, volatility, liquidity, and supply. Then add the lender's retail layer and adjust it for the borrower and the loan. The Fed influences nearly every link in that chain. It sets only one link directly. History has demonstrated this separation before. In May and June of 2013, the federal funds rate remained near zero. Then investors began to expect the Fed would slow its bond purchases. The 10-year Treasury yield rose by almost a percentage point, and the average 30-year mortgage increased by about 1 percentage point from mid-May to late June. No conventional rate hike was required. The same lesson appeared in the opposite policy direction in late 2024. From September through December, the Fed cut its target by a full percentage point, yet Freddie Mac's 30-year mortgage moved from about 6.09% in mid-September to 6.85% in late December. Markets had already anticipated some easing, then revised their views of inflation growth and the future path of rates. These examples do not prove that the Fed is irrelevant. If the Fed unexpectedly raises rates, promises a higher future path, or sells assets, long yields may rise. If it signals credible easing during a downturn or buys long bonds and MBS, mortgage rates may fall. The point is that markets price the expected destination before the central bank completes the journey, and sometimes before it takes the first step. This also explains why one pause can accompany falling mortgages, while another accompanies rising mortgages. During a recession scare, investors may rush into treasuries, pulling long yields down while the Fed waits. During an inflation scare, they may sell long bonds or demand more compensation while the Fed waits. No change describes the committee's action. It does not describe the economy surrounding that action. Higher mortgage rates then reshape the housing market in a way that can look equally contradictory. Buyers lose purchasing power, so demand should weaken. But millions of existing owners hold fixed mortgages far below current rates. Selling a home often means giving up a 3 or 4% loan and replacing it with one above 6%. The cost of moving rises even if the new home costs the same. Researchers at the Federal Reserve estimated that mortgage lock explained 44% of the drop in mortgage borrower mobility from 2021 to 2022. Fewer owners list their homes, so the supply of existing homes can shrink alongside demand. This is one reason high rates do not automatically produce cheap houses. The market can become less affordable and less active at the same time. The effect is uneven. A first-time buyer faces the new market rate with no old mortgage to protect. A long-time owner may sit on a valuable low-rate loan and substantial equity. A builder can sometimes offer a temporary rate buy-down that an individual seller cannot. The same interest rate shock therefore divides the market by age, timing, balance sheet, and access to financing. It also changes the meaning of a future rate decline. Lower mortgage rates would help new buyers' monthly budgets, but they could release delayed demand at the same time. More owners might list homes, increasing supply, while more buyers compete for them. Whether affordability improves depends on rates, incomes, construction, inventory, and prices together. A lower rate is helpful, but it is not a complete housing policy. So what would actually make mortgage rates fall? The cleanest path is sustained evidence that inflation is returning toward target without a renewed shock. That could lower the expected future policy path and the compensation investors demand for inflation uncertainty. One soft report is rarely enough. Bond markets look for a pattern strong enough to survive revisions, energy swings, and the next meeting, a weaker economy, could also pull long yields lower. Slower hiring, softer spending, or a recession would increase the chance of Fed cuts and often create demand for safe Treasury securities. Mortgage rates have fallen rapidly during risk-off episodes even before the Fed acts. That would reduce borrowing costs. But it is not an uncomplicated gift if the reason is job losses or falling income. The opposite path is equally possible. If inflation remains sticky, energy prices rise, tariffs lift goods prices, or growth stays strong enough to prevent cooling. Investors may expect policy to remain high for longer. The 10-year yield can rise, and a divided Fed may eventually resume increases. A pause is not a ceiling unless the data make it one. Mortgage spreads could narrow even if Treasury yields barely move. Lower rate volatility would make the prepayment option easier to price. Stronger demand from banks or other MBS investors could improve security prices. More efficient lender operations or aggressive competition could compress the retail spread. In that scenario, mortgage rates fall modestly without a dramatic change in the Fed's target. There is also a stress scenario in which Treasury yields fall but mortgage spreads widen. Investors may rush to government bonds while avoiding assets with prepayment or liquidity risk. This happened during periods of severe market disruption before central bank intervention restored functioning. Watching only the 10-year yield can therefore give the right direction most of the time and still miss the moments when the spread becomes the story. The useful dashboard is broader than a Fed countdown clock. Watch the 10-year Treasury, inflation, and employment trends, the expected path of future policy, rate volatility, and the gap between mortgage rates and government yields. Watch what the Fed does with MBS. Not only what it says about overnight money. None of these indicators offers a guaranteed closing date for lower rates, but together they reveal the pressure. For a borrower, the first practical implication is that shopping still matters. Multiple lenders can price the same risk differently, particularly when the primary-secondary spread is wide or capacity varies. Quotes should be collected within a short window and compared using the same loan type, lock period, down payment, and points. A lower rate with higher fees is not automatically a cheaper loan. A rate lock transfers part of the short-term market risk from the borrower to the lender for a defined period, often at a cost. Some locks include a float down if rates fall, others do not. The important details are the expiration date, fees, what happens if closing is delayed, and which parts of the quote are actually locked. A verbal estimate is not the same as a written commitment. Buying points is a bet on time, not merely on rates. Divide the upfront cost by the monthly saving to estimate a simple break. Even period, then consider the chance of selling or refinancing before that date. If rates fall enough to refinance soon, expensive points on the original loan may never recover their cost. If the loan lasts many years, the same points may be valuable. An adjustable rate mortgage can offer a lower initial rate because the borrower accepts future rate risk that a fixed rate lender would otherwise bear. That can make sense in some circumstances, but the reset formula, caps, margin, and worst case payment matter more than a forecast that the Fed will certainly cut. A pause is weak protection against a loan designed to change later. The largest mistake is treating a macroeconomic forecast as a personal affordability plan. Waiting for a lower rate may reduce a future payment. But prices, rents, income, inventory, and life can change while the buyer waits. Purchasing now and assuming refinancing will rescue the budget is also dangerous. A refinance requires market rates, property value, credit income, and transaction costs to cooperate. The current rise is real, but it is not a permanent law. Mortgage rates moved down earlier in the same Fed pause before moving up. They will change again as the outlook changes. The honest conclusion is conditional sustained disinflation, and calmer bond markets would help. Renewed inflation, strong demand, or wider MBS spreads would hurt. Anyone promising an exact turning date is selling confidence the market itself does not possess. Return to the buyer looking at that refreshed quote. Nothing about the house changed overnight. The Fed did not change its target. What changed was the price investors demanded for years of uncertainty, the value of the borrower's option to refinance, and the margin required to turn a bond market price into a retail loan. The extra monthly cost arrived through a chain mostly invisible at the kitchen table. That chain answers the paradox. The Federal Reserve targets the overnight federal funds rate and shapes expectations. Treasuries price time and inflation. MBS prices the homeowner's options, lenders price delivery, service, risk, and profit. A mortgage quote is where all four decisions meet. So when the next headline says the Fed paused, do not read a promise that mortgages must pause too. The pause button was pressed at one end of the financial system while the rest kept moving. The Fed writes one line, the market sends the bill.